Preparing for the ACCA Taxation (TX) exam? In this video, we'll cover unincorporated traders, an essential topic in business taxation. Let's begin. Unincorporated traders include sole traders and partnerships. Unlike companies, they are taxed based on their trading profits under income tax rules. Understand how taxable profits are adjusted for tax purposes, common in exam scenarios. To determine if an activity is a trade, HMRC considers the badges of trade, including profit motive. Is the activity intended to generate profit? Frequency and regularity. Are transactions repeated? Modifications and repairs. Has the asset been improved for resale? Financing method. How is the purchase funded? Selling personal items occasionally is not a trade, but frequently buying and selling items for profit could be. Trading income is taxed on a tax year basis. Key assessment rules include use of provisional figures. When final accounts aren't ready, estimates are used. New businesses, special rules apply in the first tax year. Cessation of a business. Profits are assessed up to the final trading date. Transitional profits. Adjustments may be needed when tax basis changes. Learn how profits are taxed in opening and closing years. Unincorporated businesses can choose between cash basis, recognizing income and expenses when cash is received or paid. Accruals basis, recognizing income and expenses when earned or incurred, regardless of cash flow. If a trader invoices £5,000 in March but gets paid in April, cash basis recognizes it in April, while accruals basis recognizes it in March. Understand when cash basis is allowed for businesses with turnover less than or equal to £150,000. To determine assessable profits, we adjust accounting profits by adding back disallowed expenses, deducting allowable expenses, making capital allowance adjustments. A trader's accounts show a £30,000 profit but include £5,000 in disallowed personal expenses. Adjusted profit equals £35,000. Be able to adjust profits in exam questions using given data. Certain expenses cannot be deducted when calculating taxable profits, including capital expenditure, purchases of assets, e.g., machinery, buildings. Personal expenses, costs not wholly and exclusively for trade. Appropriations by proprietors, owners' drawings are not an expense. A sole trader buys a laptop for £1,200. It's capital expenditure, so it's not deductible but may qualify for capital allowances. Learn the wholly and exclusively rule for business expenses. Pre-trading expenses incurred up to 7 years before trading starts can be deducted as business expenses once trading begins. If a business spends £2,000 on advertising before launching, it can be deducted as a trading expense once operations start. Understand which costs qualify as pre-trading expenses and when they can be claimed. For ACCA TX success, focus on identifying trading activities using badges of trade, understanding tax assessment rules for new and closing businesses, differentiating cash basis versus accruals basis accounting, adjusting accounting profits to taxable profits, recognizing disallowed expenses and pre-trading expenditure. Keep practicing past ACCA TX questions. Good luck!